Let's move on. In central banking news this Wednesday, the Central Bank of Kenya has delivered its 9th consecutive interest rate cut, looking to spur banking sector lending and stimulate the broader economy. And those were part of the considerations of the Kamau Tuju-led Monetary Policy Committee decisions on Tuesday, lowering key rate by 25 points to 9.0%. And let's get more details of the rate cut from the governor's briefing.
On December 9th, 2025, the Monetary Policy Committee decided to lower the central bank rate, the CBR, by 25 basis points to 9% from 9.25%. The MPC observed that overall inflation is expected to remain below the midpoint of the target range in the near term, and that this will be supported by lower prices of processed food items, stable energy prices, and continued exchange rate stability. The MPC also noted that central banks in the major economies have continued to ease monetary policy, but at a cautious and uneven pace depending on their inflation and growth outlooks. The committee also noted that average lending rates in the domestic market have continued to decline, while private sector credit growth has continued to improve, though at a slower pace than is desirable. The committee therefore concluded that there was scope for a further easing of monetary policy stance by reducing the CBR by 25 basis points. This will augment the previous policy actions, which were aimed at stimulating lending by banks to the private sector and supporting economic activity, while at the same time ensuring inflationary expectations remain firmly anchored and that the exchange rate also remains stable. The MPC will closely monitor the impact of this policy decision, as well as developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in February of 2026. The committee began its deliberations by looking at the global economic developments and outlook. They noted that despite higher tariffs on trade, global inflation is projected to decline in 2025 and also in 2026, and this will be driven by lower energy prices and reduced global demand. The headline inflation, global headline inflation, is projected to decline from 5.8% in 2024 to 4.2% this year, and a further drop to 3.7% in 2026. In regard to the international oil prices, these have moderated owing to increased production and subdued global demand, but have been volatile due to elevated global uncertainties. The OPEC Plus producers raised oil output by 137,000 barrels per day, both in November and December of 2025. It is also expected that non-OPEC oil producers will increase their production, and the main risk to oil prices relate to any supply disruptions from escalation in geopolitical tensions, particularly in the Middle East, and also in regards to the conflict between Russia and Ukraine. With regard to food inflation, this declined in November 2025 from -0.2 to -2.1%. And the main reason for this reduction was lower cereals, sugar, and edible oil prices, all of which was expected to for an increase in supply of sugar from Brazil and India, as well as Thailand, and an increase in supply of edible oils also from Malaysia. And the result would be that global food inflation index, as I said, would decline or did decline in November by -2.1. Looking at inflation of some of our major development partners, and in particular the US, UK, and the Eurozone, we see that inflation in those countries has eased modestly in recent months, but is still above the target, mainly on account of stickiness in the core inflation. On the left-hand side, you can see that that's the headline inflation for those four areas, including China. And really, as you can see, perhaps from the beginning of 2024, there really hasn't been very much movement downward of headline inflation. And again, the reason for this is, again, moving to the right side of the panel with core inflation, and core inflation has really remained well above the target of 2%. And this has kept up the headline inflation to where it is. Turning to global economic growth outlook, the global growth has remained resilient and is projected to grow by 3.2% this year. And this is supported by improved financial conditions, as well as strong consumer and business spending, particularly in the United States. It is, however, projected to slow down to 3.1% in 2026, owing to higher tariffs. Just focusing on the US, you can see